Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Devon Energy Corporation, ticker DVN. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up is market cap. The market cap is $39.9 billion, enterprise value $43 billion, so you can see about $3 billion in net debt. That's going to add some leverage on the business that can help it if it has some decent returns on capital. This is an oil, gas, and consumable fuels company. They are an independent energy company that engages in exploration, development, production of oil, natural gas liquids in the United States, has about 5,000 gross wells. Gives you some information. You can see with these beta of 2.56, one would be average, so it's about 2.5 times more volatile than normal, and very high 460% share turnover. That means if you have 1 million shares outstanding, then 4.6 million shares will trade in a single year. By looking at the return on invested capital chart, you can quickly see that this company is cyclical. Now, that's not a surprise for an oil and gas company, but this tells you very quickly what's going on. You can see you go up and then down, up and then down, up, down, up, down, up. So, and these cycles aren't very long, 3 to 5 year cycles, maybe, 20 to 40% of the time is losing money. That's actually a very high amount for a business like this. I like to buy high quality companies that have 19 or 20 years of profit. It's out of the last 20. There'll be 1 or 2 years, 0 or 1 year of losses. And yet we can see 1, 2, 3, 4, 5, 6, 7, 8 years of losses in the last 20 years. So that's a significant amount. You're automatically at 40% of the years you are losing money, and that's a little high. Not only is it cyclical, which means it's a relatively lower quality business than a non-cyclical company, but also they lose money during the down cycles. Not every cyclical company loses money during the down cycles, but this company does, and that's quite poor. In addition, even during the good years, you're not always getting above a 10% return on capital. You do during some of them, but you can see that 1, 2, 3 of your good years are not above 10%. So you have 8 years of losses, 3 years of good years above 0, but not above 10%. So over half the time, you're earning less than a 10% return on invested capital. And then when you average this out over the course of a decade, you can see your returns are negative. Negative return on invested capital, negative return on equity, negative return on assets. This right here not only means that it's average, it's a below average or bad company because you're not earning your returns on equity to justify the investment. You're also just not earning a reasonable return on capital. You're losing money too often and too wildly to be able to justify investing in a company like this. What this means on its own is I would avoid investing in them. It doesn't matter how cheap of a company you get if you can't predict the future. Now, if you were able to buy all the company and you could change their capital allocation, you could sell off assets, then you can do something where you have negative returns because maybe you can get a good deal on their assets. But look, you're paying more than their assets are worth. You're at 3.9 times price to book. So even though the earnings look cheap on the current year, that's because this has been an amazing year for oil prices. It's not sustainable. Buying at these prices is probably going to be devastating. I mean, let's just look at the valuation here. So $65 a share. You earned $2 in earnings in 2021, but you have 42 cents, 35 cents, 30 cents, 24 cents, 42 cents, 96 cents. Not a single year in the last decade. That's dividends per share, sorry. You have $4.19 in earnings per share. First of all, your dividends are substantially lower. So you're paying something like over 100 times your dividends per share. So you have less than 1% dividend yield. But look, losses. Some years here you're earning $1. Some years here you had $6 there, so maybe it's 10 times earnings on your peak earnings year of 2018. But look, you lost $31 a share 2015. That wipes out all the earnings for the last decade. You have lost money over the last decade. So yes, maybe this year looks good, but you can't extrapolate a PE of 7 if you're going to have years of losses. It's completely meaningless. So you can see the revenue, it's not like they're growing very quickly. The revenue is basically flat. Earnings per share are down, assets down. Normally I go into the income statement, the balance sheet, but it's basically meaningless here. This is a company I would avoid. I don't think Devon Energy Corporation is investable. So that's my summary. If you like this video, please hit that like button. Don't forget to subscribe. I am finding some good deals in the S&P 500. I am finding some high quality companies at good prices. Unfortunately, this one isn't Devon Energy Corporation. If you want to see those companies, then I'm going to have the playlist up above where I'm going to have already gone over 130 of the S&P 500 companies in videos, 5-10 minutes covering those companies, valuation, quality, etc. There are some good ones, just happens that this one isn't one. So if you want to stay tuned for that, hit that like button, subscribe, and do so. If you like doing these quick looks yourself, if you want to look at this software, then consider checking out quickfs.net. They are the sponsor in the description below. They're the first link in the description, and you can click a link over to them. So I use this analysis myself. This is my tool that I like to use, and so I partner with them, and I don't allow anything that I don't use myself. So click that show. I can get a commission if you sign up for a free or a paid account there with them, and I would really appreciate your support because that can help support the channel. Thank you for listening. Until next time, stop paying fees, start building wealth.